Hello friends, welcome back to the Crypto Skill, Bitcoin or Apple stock, Ethereum or the S&P 500. This is one of the biggest financial debates of our generation. Every single day, millions of people around the world are asking the same question: should I put my money in crypto or should I invest in stocks? Some people say crypto is the future of money and will make you rich. Others say stocks are the only proven way to build long-term wealth. But here is something that will blow your mind. Bitcoin touched an all-time high of $126,000 in October 2025, shocking the entire world, and today in 2026, crypto is no longer just an experiment, it has become a global financial powerhouse. So which one is better for your money? In this video, we are going to break down everything you need to know about crypto versus stocks. We'll look at the risks, the returns, the differences, and by the end of this video you will know exactly which one is right for you. Let's get into it. What are stocks? Let's start with the basics. What exactly is a stock? When a company wants to raise money to grow its business, it can sell small pieces of ownership to the public. These small pieces are called stocks or shares. When you buy a stock, you become a part owner of that company no matter how small. For example, if you buy one share of Apple, you own a tiny piece of Apple Inc. If Apple makes more money and grows, your share becomes more valuable. If Apple struggles, your share loses value. The stock market has been around for hundreds of years. The New York Stock Exchange was founded in 1792, that's over 234 years ago, and in that time, it has made millions of people wealthy. Now here is something very important about the stock market in 2026. It is no longer just about traditional companies. Today, the stock market is heavily driven by artificial intelligence. Companies like NVIDIA, Apple, and Microsoft have been the backbone of the stock market stability. NVIDIA in particular became one of the most valuable companies in the world thanks to the AI revolution, and its stock price reflected that growth massively. Some of the most famous stocks you can invest in include Apple, Amazon, Google, Microsoft, Tesla, NVIDIA, and hundreds of other companies. When you invest in stocks, you are essentially betting on the success of real businesses, companies that have employees, products, revenues, and profits. Stocks also pay something called dividends, which means some companies share a portion of their profits directly with shareholders. This gives investors a regular income even when they are not selling their shares. The average annual return of the S&P 500, which tracks the top 500 companies in the USA, has been around 10% per year over the long term. That means if you invested $10,000 in the S&P 500 and left it alone for 30 years, you would have over $174,000. That is the power of long-term stock investing. What is crypto? Now let's talk about cryptocurrency. Crypto is a form of digital money that runs on a technology called blockchain. Unlike traditional currencies like the US dollar or British pound, crypto is not controlled by any government or central bank. It is decentralized, meaning no single person or organization controls it. Bitcoin was the first cryptocurrency, created in 2009 by an anonymous person known as Satoshi Nakamoto. Since then, thousands of cryptocurrencies have been created, including Ethereum, Solana, Cardano, XRP, and many more. Each cryptocurrency serves a different purpose. Bitcoin was designed to be digital gold, a store of value. Ethereum was designed to be a programmable blockchain where developers can build apps and smart contracts. Other coins serve different purposes in the world of decentralized finance, gaming, payments, and more. Crypto markets are completely digital and operate 24 hours a day, 7 days a week, 365 days a year. There is no closing bell. Like the stock market, you can buy or sell crypto at 3 in the morning on a Sunday if you want to. The crypto market has produced some of the most extraordinary returns in financial history. Bitcoin went from being worth less than 1 cent in 2009 to touching an all-time high of $126,000 in October 2025. That means a $1,000 investment in Bitcoin in its early days would be worth life-changing amounts of money today. But as we'll see, those incredible returns come with incredible risk. Key differences between crypto and stocks. Now that we understand both, let's compare them directly across the most important categories. Difference 1: volatility. This is the biggest difference between crypto and stocks. Volatility means how much the price moves up and down. Stocks are volatile but manageable. The stock market crashed 30% in March 2020 during COVID. That was considered a massive crash, but it recovered within months. Crypto is extremely volatile. Bitcoin has dropped 80% or more multiple times in its history. In 2022, the entire crypto market lost over $2 trillion in value. Coins like Luna collapsed 99.9% and wiped out billions in savings literally overnight. This means crypto can make you very rich very fast, but it can also wipe out your entire investment just as fast. Difference 2: regulation. This is where things have changed significantly by 2026. In 2024 and 2025, Bitcoin and Ethereum ETFs were approved by regulators in the USA. This was a massive turning point. Now institutional giants like BlackRock and Fidelity have brought trillions of dollars into crypto. This has significantly reduced the risk of crypto going to zero, but volatility is still much higher than stocks. Stocks remain heavily regulated by bodies like the SEC in the USA and the FCA in the UK. Companies must follow strict rules, publish financial reports, and be transparent with shareholders. Difference 3: ownership. When you buy a stock, you own a piece of a real company with real assets, employees, and revenue. When you buy crypto, you own a digital token. Its value is largely based on supply, demand, and market sentiment, though Bitcoin is increasingly being treated like digital gold by institutions. Difference 4: market hours. Stock markets are open Monday to Friday, typically 9:30 a.m. to 4 p.m. in the USA. Crypto markets never close. This means more opportunities but also more stress. Difference 5: accessibility. To invest in stocks, you traditionally needed a brokerage account and sometimes significant capital. Today, apps like Robinhood have made it easier. Crypto is even more accessible. Anyone with a smartphone and $10 can start investing in crypto within minutes. Returns comparison: which made more money? Now let's talk about the most exciting part: which one actually made more money. Let's look at real numbers over a 10-year period from 2016 to 2026. S&P 500. If you had invested $1,000 in the S&P 500 in 2016, by 2026, that would have grown to approximately $3,800 to $4,000. That is a solid and consistent return of around 300% over 10 years. Bitcoin. Now here is where it gets jaw-dropping. If you had invested that same $1,000 in Bitcoin in 2016 when the price was between $600 and $900 and held all the way through to October 2025 when Bitcoin hit its peak of $126,000, your $1,000 would have grown to over $150,000. That is not a typo. $1,000 turning into $150,000 plus in 10 years. The difference is extraordinary. Crypto has massively outperformed stocks in terms of raw returns over the last decade. But here is the most important part: most people who invested in crypto did not hold through all the ups and downs. Most people panic sold during the crashes. Those who sold during the 2018 bear market or the 2022 crash lost a lot of money. The people who made those incredible returns were the ones who bought and held through everything: the 80% crashes, the hype cycles, the bear markets for years. With stocks the journey is much smoother. The S&P 500 has never had a decade where it ended lower than it started. Stocks have a much more predictable long-term trajectory, so yes, crypto has higher potential returns, but stocks have more consistent and reliable returns. Risk comparison: which is safer? Let's talk about risk, because this is where stocks and crypto are very different. Stock market risks. Company risk: a company you invest in could fail. Enron, Lehman Brothers, and many others have gone bankrupt throughout history. Market risk: the entire market can crash, as we saw in 2008 and 2020. Inflation risk: if inflation is high, your returns may not keep up. But overall the stock market has always recovered from every crash in history. The S&P 500 has never permanently gone to zero. This gives stock investors a safety net that crypto does not have. Crypto risks: extreme volatility. As mentioned, 80% crashes are not uncommon in crypto history. Regulatory risk: although Bitcoin and Ethereum ETFs were approved in 2024 and 2025, governments around the world can still introduce restrictive regulations at any time. Technology risk: smart contract bugs, hacks, and protocol failures can destroy value instantly. Scam risk: rug pulls, fake projects, and fraud remain extremely common in crypto even in 2026. Exchange risk: as we saw with the FTX collapse in 2022, crypto exchanges can fail and take your money with them. Always keep your crypto in your own wallet. Liquidity risk: smaller altcoins can become impossible to sell if nobody wants to buy them. However, it is important to note that the approval of Bitcoin and Ethereum ETFs and the entry of institutional giants like BlackRock and Fidelity into the crypto market in 2024 and 2025 has significantly reduced the existential risk of crypto. The asset class is now more legitimate than ever before, but volatility remains much higher than stocks. Who should invest in stocks? Stocks are best suited for long-term investors who want steady, reliable wealth building over 10, 20, or 30 years, people close to retirement who cannot afford to risk their savings on volatile assets, conservative investors who want to sleep well at night without worrying about 50% crashes, dividend investors who want regular income from their portfolio, beginners who are just starting their investment journey and want a proven, well-understood market, AI-focused investors in 2026. If you believe in the future of artificial intelligence, investing in stocks like NVIDIA, Microsoft, and Google gives you direct exposure to the AI revolution in a more stable and regulated way. If you want to build wealth slowly and safely, stocks are your best friend. Warren Buffett, one of the richest people in the world, built his entire fortune through stock investing. And his strategy was simple: buy great companies and hold them forever. Who should invest in crypto? Crypto is best suited for young investors who have time to recover from potential losses, high-risk tolerance investors who can stomach 50% to 80% drops without panic selling, people who believe in the future of blockchain technology and want to be early adopters, investors looking for asymmetric returns, meaning they want the chance to turn a small investment into a life-changing amount, tech-savvy individuals who understand how wallets, exchanges, and blockchain technology work. And here is an important point for 2026: with Bitcoin ETFs now available through traditional brokers, even non-technical investors can now get exposure to Bitcoin without managing wallets or private keys. This has made crypto more accessible than ever before. If you are young, you have a stable income, you have an emergency fund set aside, and you can afford to lose what you invest, then crypto can be a powerful addition to your portfolio. The key word here is addition, not replacement. The smart strategy: why not both? Here is the truth that most people miss: you don't have to choose one or the other. The smartest investors diversify. They don't put all their money in one place, they spread their risk across different asset classes. Here is a simple example of a balanced portfolio for 2026. Conservative portfolio: 70% stocks, index funds like S&P 500, 20% bonds, 10% crypto, Bitcoin and Ethereum only. Balanced portfolio: 60% stocks, 25% crypto, Bitcoin, Ethereum, and select altcoins, 15% other assets. Aggressive portfolio: 40% stocks, 50% crypto, 10% other high-risk assets. The idea is simple: stocks give you stability and consistent long-term growth. Crypto gives you the potential for explosive returns. Together they create a powerful investment strategy. And remember, always use the dollar cost averaging strategy. Invest a fixed amount regularly regardless of the price. This removes emotion from your decisions and builds your portfolio steadily over time. Conclusion: so crypto versus stocks, which is better in 2026? The honest answer is it depends on you. If you want safety, consistency, and long-term proven returns, stocks are your best choice. And with AI driving companies like NVIDIA and Microsoft to new heights, the stock market has never been more exciting. If you want high risk, high reward potential, remember Bitcoin hit $126,000 in October 2025, and with institutional money from BlackRock and Fidelity now in the market, crypto has never been more legitimate. If you want the best of both worlds, invest in both and diversify smartly. But no matter what you choose, always do your own research, never invest more than you can afford to lose, and always think long term. If this video helped you, please hit the like button and subscribe to the Crypto Skill for more videos like this. Drop a comment below. Are you a crypto investor, a stocks investor, or both? See you in the next video.